There are just some things in life that can be so confusing that you just want to pull your hair out. Now, whether that's trying to understand why your Wi-Fi doesn't work even after you reset the router, or in this case, what to do when inheriting an IRA. There are a lot of rules that apply to inherited IRAs, whether it's your relationship to the original owner, the original owner's age, when they passed, whether or not they were taking RMDs, and those are just to name a few. In this video, I'm going to talk about what you need to know if you're inheriting an IRA. Hey everybody, I'm Jonathan Rankin, the founder and CEO of Theorem Wealth Management. My firm and I have been helping clients plan and execute their retirement by focusing on three key areas: maximizing retirement income, optimizing investments, and reducing taxes. Now, if you were thinking about retirement or you're already retired, make sure you hit that subscribe button so you don't miss any of our retirement videos or episodes of our weekly retirement podcast called The Retire Once Show. For investors, the IRA has always been a great place to save, defer taxes, invest for retirement. But for the IRS, it's a large bucket of untapped tax dollars. Remember, any dollars in a traditional IRA, 401k, or other tax-deferred account, the money is not taxed until you take the money out of the account. At that point, it's ordinary income. For years, inheriting an IRA was actually pretty easy. But then Congress went along and passed the Secure Act. And starting January 1st of 2020, things got a lot more complicated. So complicated that the IRS is still publishing regulations on how the original rule should be interpreted. Because of this tug of war between individual investors and the IRS, it's extremely important to understand the tax implications when inheriting an IRA. So let's start with inheriting your spouse's IRA. If your spouse passed away and you're the sole beneficiary of your spouse's IRA, you can essentially take over the account. This is known as a spousal transfer or assuming the IRA. And the IRS is going to just treat this as it's been your IRA all along. That means you can make contributions to the IRA, and the schedule for required minimum distributions is now reset to your life expectancy. As a sole beneficiary, you can also move the assets into your name and continue to stretch the IRA over the course of your lifetime. For spouses, things are pretty simple. It's when you inherit an IRA from a non-spouse where things can get really confusing. The goal for most people when inheriting an IRA is to use that money to maximize their life and pay as little as possible to the IRS. That's why it's important to understand the rules and start planning early in the inheriting process. And with the passing of the Secure Act, the old rules of being able to stretch the IRA and continue the tax deferral changed, and the IRS introduced the new 10-year rule. The general rule for non-spousal beneficiaries is that you must withdraw all of the money from the account by December 31st of the 10th year after the original owner passed away. Now, the IRS's 10-year inherited IRA clock starts in the year after the original owner passes away. That essentially means you have 11 years to drain the account if you start taking money out in that year the original owner died. During that 10-year period, the beneficiary isn't required to take any annual RMDs. The only thing that matters is that the account is emptied in the end. Now, this gives you some flexibility. If you're inheriting an IRA, you could take it all at once. You could space it out over that entire period. You can wait until the deadline and take it all then. Now, this is where you want to be really strategic in how you withdraw the assets. Because remember, every dollar that comes out is considered ordinary income. There are a number of scenarios that are extremely important to plan ahead for. For example, if you have kids that you're expecting to go to college in the next few years, financial aid looks at the previous 2 years of income, so you might want to wait until that process is over before you start taking distributions from your inherited IRA. And then if you're approaching retirement and you still have your salary today, but you know that your income is going to be lower in the next couple of years, what if you're already retired? You want to be strategic there because you could impact how your Social Security is taxed, could impact your Medicare premiums, or even subsidies that you might receive on healthcare. And then for normal taxpayers, you could lose tax credits or deductions. It could put you in a higher tax bracket, which could phase you out of things like Roth IRA contributions. All of these things you need to consider, and that's why it's important to really map out that 10-year period. Now, there are some exceptions to that 10-year rule. If you are disabled or chronically ill, as long as you meet the IRS definitions of either disabled or chronically ill, then annual RMDs can be based on your life expectancy. Minor children of the deceased are also exempt from the rule, but there is a catch. For minors, annual RMDs based on that child's age can be taken until the child reaches the age of majority in their state, which does vary state by state, but it's typically around 18 years old. At that point, any money remaining in the IRA will need to be withdrawn according to that 10-year rule after they reach that age of majority. Now, this exception only applies to children, not grandchildren, nieces, or nephews. It's only children of the deceased. Now, the last type of beneficiary that is exempt from the 10-year rule is any individual that is within 10 years of age of the deceased. So if it's a sibling or a friend, or just anyone within 10 years of age is exempt from that 10-year rule and can take RMDs based on their life expectancy. Initially, when the Secure Act passed, there was a lot of confusion on that 10-year rule. It was initially thought that even if the deceased was taking RMDs at the time, that the beneficiary wouldn't have to, and they could just follow the 10-year rule, and as long as the account was depleted after those 10 years, they were fine. Now, it wasn't until this year that the IRS came out with some clarifications on the They now require beneficiaries that are using that 10-year withdrawal schedule to also take annual RMDs in years 1 through 9 and fully deplete the account by December 31st of that 10th year, provided that they inherit an account from an owner who is already taking RMDs. Now, this doesn't mean that you can't take more than the RMD or that you couldn't deplete the account earlier if you wanted to. It just means that if RMDs were started, then they must continue. This rule will not be enforced until 2023 because there was a lot of uncertainty around the rule to begin with, and they just came out with clarifications this year, so they're going to give people time to adjust. As you can see, there's a lot of confusion around inheriting an IRA and when you must start taking distributions from the account. That's why it's important to start that planning process now if you are expecting to inherit an IRA. But even if you're not expecting to inherit anything, but you're saving in an IRA for yourself and for your own retirement. If part of your long-term plan includes leaving a legacy to your beneficiaries, then starting that planning process early can help create the most tax-efficient transfer possible. If you want to learn more about ways to reduce your taxes or your beneficiaries' taxes, use the link in the description below and let's schedule some time with a member of our team. We would be happy to help walk you through your specific circumstances or answer any questions you have when it comes to inheriting an IRA. Because when it comes to family dynamics and retirement, things can always get muddy and complicated. And nowadays, more and more children are helping with the care of their aging parents. Now, for more about how aging parents can impact your retirement, be sure to check out this episode of our retirement podcast called The Retire Once Show, where we go into detail on caring for aging parents. I'll see you there.